Let's turn to the advisory now with a look at self-managed super funds. And joining us is Travis Schindler from Hewison Private Wealth to discuss
Good afternoon, Andrew.
exactly what they are. Travis, yeah, good to catch up with you. All right, so at the beginning of a new year, of course, perhaps not a bad time to consider retirement planning, if you like, and your super and how to manage it. So, self-managed super fund, for those uninitiated, what are they?
A self-managed super fund, Andrew, is effectively what can be viewed as a private superannuation vehicle, typically for a family or typically a husband and wife couple or a family group. It's effectively governed by the same superannuation rules as retail or industry super funds. The key difference is that self-managed super funds are regulated by the ATO, so that does come with an added layer of compliance requirements, most importantly an annual tax return. But ultimately, the reason for the super fund itself is the same as the industry or a retail fund, which is to provide for future retirement benefits of Australians.
All right, so what would you need to consider if you were to set one up? And particularly, I guess, in terms of your financial outlook, how you place, perhaps your stage in life?
Look, certainly there's some important considerations. As the name suggests, it does mean that you're the trustee of your own superannuation fund. So you can either manage it yourself or you can employ the services of professionals to help you administer and advise on the running of your self-managed fund. But ultimately, no matter how you manage that, you are still legally responsible as the trustee for your own super fund. So the willingness and the desire to take on that added complexity must be considered, and a certain level of skills must also be considered, with the help, of course, from tax accountants or wealth management professionals and financial advisors to assist with that along the way.
All right, so as you mentioned, more complex, potentially onerous for you. Let's look at the positives though, particularly compared with a retail fund.
So look, retail funds are typically designed to achieve profit. So what we see with the advised families that we work with is that retail funds can be more expensive. The investment choices can be, in some cases, limited, and there can be layers of fees that, to be quite honest, most superannuation members didn't even know existed until a deep dive is undertaken. So retail super funds can be costly with more limitations on what investments are available. Industry super funds typically can be more cost effective, but again, you are limited with the types of investments and the flexibility available. So look, not to say that industry funds don't have a place, because they absolutely do in the growing superannuation market, but for those that want to have more control and flexibility over how their superannuation is invested and the type of plan that they're implementing for accumulating their wealth, a self-managed super fund is something that can certainly be considered. So another consideration is the cost. So typically, the whole arrangement of a self-managed super fund can be more costly. So it is important to make sure that a household or family's balances that they're using for a self-managed fund is sufficient to justify those costs.
Is it particularly advantageous if you're a small business owner, particularly as you're juggling cash flow?
Yeah, thanks, Andrew. So I mentioned the control and flexibility, and with regards to flexibility, a key benefit of a self-managed superannuation fund is the ability for business real property to be owned and operated from within a self-managed super fund. So within superannuation and self-managed super, prohibitions around related party dealings and in-house assets are critical. The ATO is very strict around dealings with related parties, but there is a carve out for business real property. So if you own your own business, manufacturing or a tradesperson, for example, operating an industrial property out of an industrial property owned by a super fund is an example of the flexibility that a self-managed super fund can provide. So look, there can be complexities associated with that. In fact, there are, but there are absolutely benefits. For example, paying yourself rent and building a retirement asset base for your future, rather than having that leakage to a third party.
And what of tax treatment? Potentially, what are the benefits?
Well, with regards to from a superannuation perspective, any rent paid into a self-managed super fund is taxable income of that fund. So during the accumulation phase, the tax rate is 15% on income earnings. So the tax rate on the rent received can be more advantageous than if that was potentially owned by other vehicles, such as a corporate entity or individuals or a trust, for example. So it is critical to seek tax advice, but ultimately a self-managed super fund operates in a more concessionally taxed environment. So receiving those rental payments can be more advantageously taxed. And of course, if there is a liquidity event on that asset over the long term, if it's sold during the retirement phase, for example, there's an opportunity for that asset to be sold at a 0% tax rate if a couple of considerations are met.
Are there any legislative changes you'd need to consider? Obviously, the government has put forward a number of changes more broadly as it applies to super. What those specifically for SMSFs?
Yeah, look, I think superannuation in general is, over the last decade has become more complex, which has pros and cons, but certainly something that has been spoken about over recent years, and I'm not sure that it's going to get up. In fact, I don't think it will in the next year or two. Is Division 296 tax? That's effectively the additional tax levied on superannuation balances with north of $3 million. Something that's really important to consider is that it's on an individual member level, not on the fund level itself. So for a two-member fund, that's you can have up to $6 million and potentially be able to avoid those future changes. So there's been a bit of back and forth on that coming into effect, but at this stage, it's looking like agreements are being difficult to reach. But look, overall, I think the most advantageous change to superannuation in recent years is the ability to contribute up to the age of 75. Many retirees aren't aware that those changes took place 2 or 3 financial years ago. So previously, up until the age of 67, and even before that, capped at 65 years of age, you couldn't put any more money into superannuation. As of today, up until the age of 75, really, a retired individual can add money to superannuation on a tax-free basis, subject to other conditions being met. But that is really important to consider.